Hello and welcome. You're watching the Hindustan Times. I'm Abhishek Singh. Let me ask you a question. Why do you work? Chances are, no matter where you're watching this from, which age group you belong to, that you work to gain financial independence. Somewhere in that response, this phrase could be found. How do you gain financial independence, especially in the times that we live in, where layoffs are a reality, market volatility is a reality as well? You can perhaps do that by investing in safe instruments. Safe, relatively speaking. And in that regard, bonds are something which do raise their head as a very viable vehicle of investment. Now, if I were to show you some numbers and talk you through some of the numbers which are important in this context, is that India's overall savings rate remains robust, but household financial savings have dipped to a 43-year-old low. What does this tell you? This tells you that savings alone are not going to be enough. And as it is, you might not be in a position to save as much as you ideally would have wanted to. But having said that, there is another reality which you can look at, and that is what is happening in the bonds market. Like I said, those are a safer option as far as investment is concerned. So the Indian corporate bond market is now valued at more than rupees 51.58 trillion. And the overall bond market outstanding is expected to reach approximately $2.78 trillion by March. That is a massive number. But as far as bonds are concerned, if you're somebody who doesn't know how bonds work, how could you invest in bonds? What kind of risks are involved? And how could you go about investing in bonds? Well, you've come to the right place. You're watching the right video. Watch it in entirety. I am joined by Mr. Saurav Ghosh, co-founder Giraffe, to discuss just this. Thank you, Mr. Ghosh, for taking the time and talking to us and doing this. Name is Bond, right? So with such a heavy name comes a very important, very heavy responsibility as well. And that is, like I said, is to help people generate a secondary income stream. Could you tell us why bonds could be, given the kind of exposure they may not have to the markets like equities, and thus not prone to that kind of fluctuation which we see in the equities market? Why could bonds be that important source of investment?
Thanks, Abhishek, and thank you for having me here. I think we need to understand the Indian saver better. And the Indian saver today is, I would say, risk averse. They are actually striving for more predictability and stability with their financial portfolios. Everyone today is investing either in fixed deposits or in equities. And I think both of these asset classes have their own nuances. Why it's not, I would say, optimum for creating the best financial portfolio. For example, if you look at fixed deposits on a post-tax basis doesn't even beat inflation. You will probably make 7% pre-tax, maybe 4 to 5% post-tax. And if you look at equities, you're largely investing for maybe a 5 to 10 year view. What do you actually do with your money if you have needs which are not long-term and you actually want to grow your wealth? And that's where bonds come in. So if you need to make an investment, let's say with a time horizon of 1 year, 2 year or 3 year, you really don't know where the equity markets will be. You can put money in fixed deposits, but your wealth will actually erode because it doesn't beat inflation. And that's where bonds hit the sweet spot. You can make a 2-year investment, maybe earn a 10-11% return on a post-tax basis, beat inflation. And this is completely predictable. So you will exactly know, on which particular date your money will come back. You can actually build a very, very high quality portfolio with stability, with predictability, not exposed to market risk, let's say for a 1 to 2 year time frame. And that's why, what I say is that bonds is the most powerful investment option for your short to medium term needs.
All right. Let me give you some numbers, and then we'll work with these numbers and explain the story, the bond story through these numbers. And one of those important numbers is that the overall savings rate, as far as India is concerned, that remains robust. But household financial savings have dipped to a 43-year-old low. And financial saving of households is at 5.1 to 5.3% in fiscal year 2023. Now, savings, investments. So for somebody who's starting out, let's say at the age of 24, 25, which is when you typically pass out of college and you start your job. You're starting there. So what kind of allocation are we talking about? Because savings, as we know, are going down because consumption is increasing. But having said that, what kind of allocation are we talking about? Let's say somebody at the starting salary of 50,000 rupees.
So I would say first and foremost, anyone who's starting out, first needs to put aside their emergency corpus or corpus they might need in the next 3 to 6 months. So for that, I would still recommend that, keep it in cash or keep it in fixed deposits. Now let's say that you have created that emergency corpus. What do you do with your, I would say, surplus capital to grow your wealth? So once you're done with your emergency needs, you're trying to grow wealth. And again, that's where bonds will come in, or the other asset classes will come in. Someone with 50,000, I would say that you can allocate 20 to 25% of your monthly surplus or savings to fixed income and bonds. So that would be, let's say, 10 to 15,000 a month. You can keep investing in bonds. And the good part about this is, let's say that you invest every month 10,000. Over a period of a year, you would let's say invest 1,20,000. All of this you would actually get back over the next 2 to 3 years. So you can, as your wealth increases, as you have a longer period in your professional career, 3-4 years down the line, you can actually make more smarter choices that how do I want to reinvest my money, where do I want to then allocate next. When you're starting out, you don't have answers to all the questions. So probably taking a more short to medium term view, when you're just starting out, probably is a more prudent way of, building your wealth. And that's why I say that, maybe 20 to 25% at least, is where you should be investing in bonds.
Right. And that number that you mentioned there, although it was in different context and that was 10,000, 10,000 is also now the minimum threshold for someone to enter the bonds market, right? And that is a big, massive change, because so far, bond market was limited to, the moneyed. Those who had big chunk of money, they could, enter the bond market, reap those returns, protect themselves and their wealth from erosion and market fluctuation. Retail investor did not have that option. So talk to us about the significance of this step of lowering down this threshold to just 10,000 rupees.
So I think historically, right, like if you look at the bond markets in India, only the institution, and when I say institutions, banks and insurance companies, public provident fund, large-scale institutions had access to high-quality bonds. And I think the regulator and the government over the last 3 years have done a lot to actually deepen the bond market in India. They want increased retail participation in the bond market. One of the reasons for that is, unlike equities, when a retail investor invests in equities, India as a country actually doesn't benefit. But when a retail investor actually invests in a bond, that that money is actually going to a corporate who will probably reinvest that in some capex, to grow their own business, and thereby actually leading to better development in India. So SEBI is actually helping and trying to encourage retail investors to invest in bonds, and it helps the nation as well. Now, one and the most important step SEBI took in that, I would say, journey is reducing the ticket size to 10,000 rupees. So now from large-scale institutions having access to, I would say, bonds in India, now with a 10,000 rupee ticket size, every person, you and me and, someone who's starting out his job can actually start creating a high-quality bond portfolio. So as we said, right, so from 10,000 rupees, and actually if you want to invest in, government securities and treasury bills, that ticket size is as low as 100 rupees right now. So with SEBI bringing down the threshold, we are now seeing, the democratization of the space, where not just HNIs and large institutions have access, but retail investors like you and me have access to, I would say, very, very high quality, bonds out there.
Before we go and start talking about diversification, etc., within, of course, your bond portfolio, let's quickly, also do a pros and cons versus equity investment, let's say. So if you could sort of, just list 3 pros and 3 cons in favor of bonds and against.
So I think, let me begin by saying that, it's not about competition, bonds.
I mean, these are different asset classes,
Absolutely,
different advantages
right? So
and
there are different trade-offs. And,
yeah.
I think so, if I just look at equities, some of the good things about equities is that obviously the compounding story is real with equities. If you have a 5 to 10 year view, equity is a great asset class. India as a country is doing well. So your equity portfolio over a long-term period is likely to do well. Now let's look at the downside of having, too much exposure to equities. The downside actually is that, it doesn't give you peace of mind if you're overexposed to equity. Let's say I have 80, 90, I know people today who have 100% exposure to equities. And over the next 1 year, 2 year, cycle, you see a macro event, obviously like the US-India trade war is happening, some election in India, or, some other oil prices, any other macroeconomic shock, you will realize that in 1-2 years, your equity portfolio is actually down by 30%. And if you have 100% of your capital exposed to equity, in a year or two, you'll realize that I'm actually 30%, my net worth has gone down by 30%, which is not, I would say, which leads to a lot of stress, situations of panic. So that's the downside of having over allocation to equities, the volatility of it. Now let's look at how bonds, comes into this space, right? Bonds can give you, let's say, 10, 11, 12% return on a pre-tax basis, and it is completely stable and predictable. It means that if I'm investing in a 2-year bond, I know exactly how much money I will get back on which particular date in that 2-year journey. So I have actually now created an investment vehicle or an asset where I know how I will get my money back, at what return I'll get my money back. And I think that's the kind of predictability and certainty we all strive for. And what I say with bond versus equity is, it's not that equity is more risky and bond is more safe. I think what, having both in your portfolio achieves is, equity gives you long-term wealth creation, and bonds actually gives you that time and space needed to stay invested for the long term. Because let's say in 2 years your portfolio is down by 30%, and if you have a large exposure to bonds, you at least know that my bonds exposure is doing all right. It gives you the peace of mind, it lets you sleep better, and it also helps you stay invested in equities longer. And if you see your 10-year financial journey, you'll just realize that you were such a better and much smarter investor over a 10-year period because you had allocation to both.
Yeah, that's such an interesting point, because every time you look at your equity portfolio, depending on the macro conditions that we were talking about earlier, it might be down and you might be tempted to sort of, pull it out. But then we all know over decades, equity market tends to beat, a lot of other instruments of investment. Having said that, let's talk about Giraffe a little bit, because your platform is helping the retail investor enter the bond market, right? So say I'm somebody who wants to enter into the bonds market. My capital could be, right, let's say from 10,000 all the way to 1 crore, 1 lakh, whatever that number might be, because that'll be different for everybody, right? So as soon as I register, how soon can I start investing? And after this, we will talk about diversification.
Yeah, so I think the foremost role that Giraffe is playing in this journey is now giving a digital platform which makes it really easy for retail investors to invest in bonds. The journey is very simple. You come in, you can log in, you do your registration, which will take a minute. It's essentially just your phone number and email ID. There's a KYC process as mandated by SEBI. That KYC process will take you under 5 minutes, and in under 5
minutes...
Video
KYC, right?
Yes, video. And in under 5 minutes, you're ready to make your first investment. So, the journey from registration to your first investment is as fast as under 5 minutes. At Giraffe, we actually want you to spend more time in understanding, the category, understanding, the bond, looking at a few opportunities, make your investment decision. So we want you to spend more time in understanding what you invest in. So the other part of the digital journey is going to be really quick, smooth, and transparent.
So if I have some questions there, let's say I'm not that aware, don't know that much about the bonds market. If I want to know what's the difference between AAA and AA, will those questions also be answered on the platform?
Yeah, so I think this is answered in 3 steps. First and foremost, with respect to category like AAA, AA or a specific investment opportunity, we put out a lot of information out there, which is very simple and easy to consume. So you can actually spend time on the platform, understand what a AAA bond is, AA bond is. If you want to invest in, for example, a Muthoot Finance bond or a Shriram Finance bond, you can even go and understand the details of that particular bond. So there's a lot of information that is very easy for you to consume, which will help you understand, what you need to. If you don't find that enough, we have a Giraffe AI, which is our own AI bond conversational tool. You can actually now engage and interact with the AI tool to ask questions on top of the data that you have consumed. Obviously, this tool will help you get answers to most of the questions that you might have. The third step is obviously we have dedicated RMs for each of our customer. If 1 and 2 is not enough, you can always pick up the phone or reach out through a chat interface to your RM and ask any question that you need to. So we are out, we are there to help you, I would say start your bond investment journey. That's what we do at Giraffe.
Yeah, and on top of that, people should always be talking to their financial advisors. Right. Having said that, now since we touched upon it, let's not, ignore it and move on to the next subject. And that is, of course, we were talking about the kind of bonds, the different type of bonds which retail investors can invest in. So if you can just list them out and a point or two about the advantages of investing in a particular type of bond.
So I'll take the analogy of the equity market because everyone understands that space well today. So for example, in the equity market, we have a large cap, mid cap and small cap. In the bond space, similar to large, mid and small, we have something called ratings. So the AAA, AA rating is similar to, I would say, a large cap, kind of a company that you might think of. Once you look at A, so that
just means more safer, right?
That means these are companies that are larger and much more safer. Then, for example, the A ratings would be equivalent to maybe a mid-cap, companies, and then there are BBB rated companies which are more equivalent to a small-cap companies. Now, AAA to BBB, these are all investment grade, I would say ratings in that sense. What it denotes, as you rightly said, is AAA rated means that this company is the safest. It also means that you will get the lowest yields typically in this company. When I say lowest yield, it means lowest return.
Because the risk is low.
Because the risk is low. So low risk, low return. You go all the way down to BBB, it will be, I would say, higher risk, obviously compared to a AAA, but you also get a higher return.
Right.
Now, let's understand the trade-off between how much risk is how much return. Right, so I would say the single biggest risk in bond is what we call as credit risk, and it means that because you're investing in a bond, it means you're giving money to a particular company. How likely is that company to going to repay your bonds? How likely that company is going to repay the bonds? So this risk, where the likelihood of the company repaying your money is what we call as credit risk. So credit risk is I would say the risk that every investor needs to be aware of when investing in this asset class. So credit risk for a AAA rated bond is the lowest, and credit risk for BBB is higher than obviously for a AAA.
Right.
Now, if I just give some numbers over here and people can consume it the way they want to, if you look at like a 3-year default history of AAA, AA rated papers, it's 0.0%. And what I mean by that is, if you invest in a AAA or AA rated bond within a 3-year horizon, means your money will mature in 3 years. Historically, last 5 years, the default rate has been 0.0%. Similarly, if you go down to BBB, the default rates goes all highest up to 2%. So your default rate goes up to 2% while you move from AAA to BBB. Now the yields
and what factor has or what percentage has the return increased by?
Yeah, so that's what I'm coming to. So AAA bonds today will give you about 7.5% yield. BBB bonds will give you about 13 to 14% yield, or I would say 12 to 14% yield. So by the percentage or the chance of default going up by 2%, you're actually almost earning 100% more, from 7.5 to I would say 13, 14,
right.
Maybe 80, 90% more, right? So that's the trade-off that an investor wants to take. Now coming to the way they should be creating a portfolio on Giraffe, I would say we need to understand the investor type. There is not I would say a one size fits all kind of solution. So are you a conservative investor? Do you feel you have a higher risk appetite? That the investor needs to make that choice.
So say I am. So say I am a conservative investor, yes, and I want to add bonds to my portfolio. Mm-hmm. So first let's just talk about that chunk, mm-hmm, the investment that I am going to make in bonds, and then within that we will further talk about if we need more diversification within, yes, bonds,
right,
of that portfolio.
Mm-hmm. So I would say if you're a conservative investor, overall allocation to bonds in your financial portfolio actually should be very high, right, because as we said that equities has a risk of volatility. Obviously, if you make bad choices in equity, there's also a probability you lose money, right? In that sense, bonds are fixed and predictable, right? So fixed, stable and predictable. So if I'm a conservative investor, actually I should have 60-70% allocation to fixed income, which is FD plus bonds. And I would say anything beyond your emergency capital, FDs is not efficient. You will get higher returns even in AAA rated bonds compared to FDs, right? So I would say 60-70% to fixed income. In that, I would say at least 50-60% bonds, right? So if you are a conservative investor, that's out of your overall financial portfolio, 50-60% should be in bonds. Now let's come to the diversification within bonds. Out of your 50-60% allocation, because you're a conservative investor, it means that capital preservation is of paramount importance, right? So we will not take any risk with capital at all. So I would say within that 60-70% you should be investing in AAA or AA rated papers, as I said, which has almost a 0.0% kind of a default history. So
but that is for a very conservative, as
I'm saying, for a conservative investor. In that 20%, maybe you can then add on with maybe, like as I said, the mid-cap portfolio, which is your A-rated papers, and maybe 10-15% you can take your small-cap portfolio, which are BBB. Overall, what it helps you do is it will give you that return bump up. So overall, this portfolio can still earn maybe a 9-9.5%. compared to an FD which will be giving you, let's say 7.5%, right? So you're getting almost a 2% delta with stability, predictability, taking very, very minimal risk, and you have a very high quality portfolio. The second part in creating a portfolio is understanding how to stagger cash flows.
Right.
And when I say stagger cash flows, it means you can invest in a bond of 1 year, 2 year, 3 year. I will also recommend that every investor invests across all these 3 tenures in some sense.
Why so?
Because you don't want all your money coming back to you after a year or 2 years, right? Because then reinvesting a large corpus becomes troublesome. You'll not need all your money at a single point in time. So you invest in a bond which will give you money in 1 year. You also invest in a bond which will give you in 2 years. You also invest in a bond which will give you in 3 years. So you'll keep getting cash flows at regular intervals. Every time that you can make a choice. How do you want to reinvest? Do you want to reinvest in bonds? Do you think equity market is at a low, so probably you want to invest in equities? Or you have some expense, so I'll just take the cash and use it for my expenses. So the idea is invest across these tenures, so that way your cash flows are spread out and you will have options throughout your I would say investing journey.
Right. Now, for people who might still be fence sitters and believe that numbers is where the power comes from, right? What kind of numbers have you seen, the uptick that you might have noticed in the bond markets as far as the retail investors coming in is concerned? If you could take us through that, let's just talk about the last couple of years.
Yeah. So I would say last couple of years has been phenomenal for the bond market growth, especially from the retail investor side. I think some of the thing that has played out is obviously equity markets has been really volatile. Obviously, thanks to Mr. Trump, he's created a lot of macro volatility. So, and we have seen what kind of return the equities have given in the last 2 years. Now people have actually realized that bonds giving 10, 11, 12% is actually very, very good if it's stable and predictable. So that last 2 years, that awareness has kind of caught up. We see a massive influx. Right now, I would say the industry is growing at almost 30% quarter on quarter. So when we started 2 years back, the entire the bond industry was probably doing about I would say 500 crores a quarter just from a retail segment. Today I would say we have grown 10x, where I would say retail participation in bond is 5,000 crores a quarter. So that's a massive jump that has happened from I would say 2 years back to now. So almost a 10x jump. Even today at this pace, the industry is seeing almost 30% quarter-on-quarter growth, when it comes to retail participation. I think it's just fantastic how people have really caught on to this asset class. I think in the next decade, how we've seen the mutual fund inflows and the SIP inflows, I think we'll see similar inflows in the in bonds as well.
Yeah, also because if you look at the equity market, for example, if you look at gold prices. Gold prices are at its peak, silver prices as well. So the instruments, the avenues where you can invest and generate a certain amount of return year on year, well, those possibilities, those opportunities are not as many as they were perhaps 5 years ago, just after COVID, right? So having said that, my last question to you is, of course, on what do you see? What do you see over the next 5-10 years happening in the bond market? What kind of investor inflow you're looking at, the numbers, and also, of course, what is a larger picture for you as an organization?
So I think first and foremost, the next 5 years, I just want to spell out, I think the Indian investor is going to change fundamentally when it comes to investments, right? So one, I would say behavioral shift that we are already seeing is that because people have become more affluent today, there is increasing wealth in India as a country. So people are looking to obviously invest in many asset classes. The second is people have become more savvy. And with them becoming more savvy, today they are actually now investing to optimize for cash flows and not just for return. So it's not just good enough that I'm earning 13, 14 or 15%. It's also how do I invest so that I can make my next vacation? How do I invest so that I can buy my next car? And how do I invest so that I can buy my next house? So as people try to optimize for cash flows, as people are more oriented towards financial goals, so they make investments accordingly. And that's where, I would say bonds will just explode as a category and an asset class over the next 5-10 years. So this is more on the overall space and the category. Now, when it comes to Giraffe, what we feel is that, if you look at larger global markets, debt or bonds is actually a larger category than equities. In India, bonds is, I would say, a percentage of the overall equity market. So I feel that we have a lot of catching up to do in India. We'll see that catching up over the next 5 years. Today, I would say the large scale equity platforms have maybe 10-15 million users. I think in the next 5 years, that's where we want to be as Giraffe, from the number of retail investors participating in bonds. So I would say that, 10-15 million users, out of the overall Indian investment landscape, I think is still a fraction of the overall pool. But I think in the next 5 years, we should be able to get there.
And actually, before I let you go, interesting name. You want to tell us a story behind the name giraffe?
Absolutely. So I think first and foremost, we look at giraffe as an animal. The animal, exudes stability. The good thing about giraffe is also, because it's tall, it can actually pick and choose any fruit from a tree. So typically it picks and chooses the best and the juiciest fruits from the tree. So we as a platform as Giraffe, we pick and choose curated opportunities from the overall bond market, which we believe are the best for our investors to participate in. So Giraffe is your platform for stability. It has the best curated products. Basically the best fruits of the tree are on Giraffe.
So for people who want safe, sure and fixed returns, safe and sure only of course to the extent that an investment instrument can be, because it is subject to all kinds of forces. In this case, for example, credit risk. Bonds is perhaps what people should look at. But on that note, thank you so much for discussing this at length with us. And for anybody who might be watching it from wherever across the country, this would definitely help them understand the bonds markets a little better. And of course, perhaps also make that decision whether they want to enter the market as a retail investor or not. But on that note, thank you so much, Mr. Ghosh, for taking the time and talking.
Absolutely. Thank you for having me. Thank you.